Hey everyone, and welcome back to the channel. Ever feel like you're always late to the party when it comes to stocks? You hear about a company soaring, and by the time you look, the price is already sky high. What if I told you there's a strategy that's all about getting in before the hype? It's called value investing, and it's how legends like Warren Buffett built their fortunes. Stick around, because today we're breaking down exactly what a value stock is, how you can spot one, and how to figure out if it's trading at the right price. So, what exactly is a value stock? Imagine you're at a flea market and you see a beautiful, solid wood table priced at just $10. You know it's worth at least $100. That's a value deal. A value stock is the same idea. It's a share in a great, solid company that, for whatever reason, the market is undervaluing right now. Maybe they had a rough quarter, or maybe they're just in an industry that's not trendy at the moment. The key is, you're buying a quality business for less than its actual worth. You're not chasing trends, you're hunting for bargains. Alright, so how do we find these hidden gems? There are a few key metrics value investors live by. First up is the price-to-earnings ratio, or PE ratio. This tells you how much you're paying for every dollar of the company's profit. A low PE ratio, say under 15, can be a sign of a value stock, but don't stop there. Next, look at the price-to-book ratio, or PB ratio. This compares the company's stock price to its book value, which is basically what the company would be worth if it sold all its assets and paid off all its debts. A PB ratio under 1 means you're technically buying the company for less than its net assets are worth. That's a huge potential green flag. Another great indicator is the dividend yield. A company that consistently pays a healthy dividend is often a sign of a stable, profitable business. If the stock price is low, that dividend yield looks even better. It is like getting paid to wait for the market to realize the stock's true value. But here's the million-dollar question. What is the right value? This is where it gets a little more advanced. Value investors try to calculate a company's intrinsic value. Think of this as what the company is truly worth, separate from its current stock price. One common way to estimate this is through a discounted cash flow, or DCF analysis. It sounds complicated, but the basic idea is you project the company's future cash flows and then discount them back to today's value. If your calculated intrinsic value is significantly higher than the current stock price, you found what value investors call a margin of safety. This margin of safety is your cushion. It's the difference between the intrinsic value and your purchase price, which protects you if your calculations are a bit off, or if things don't go exactly as planned. The bigger the margin of safety, the lower your risk. So, you're not just buying a cheap stock. You're buying a great business at a price that gives you a built-in advantage. To recap, finding a value stock is about doing your homework. You're looking for good companies that are temporarily out of favor. You use metrics like a low PE ratio, a low PB ratio, and a solid dividend yield to find potential candidates. Then, you dig deeper to estimate its intrinsic value and ensure there is a good margin of safety before you invest. It takes patience and research, but it's a time-tested strategy for building long-term wealth. I hope this gives you a clear starting point for understanding value investing. It's a powerful approach that shifts your focus from short-term market noise to long-term business quality. If you found this helpful, be sure to hit that like button and subscribe for more content to help you on your financial journey. Thanks for watching, and I'll see you in the next video.